The S&P 500, the Nasdaq Composite, the Dow Jones, and the ASX 200 are all examples of stock indexes. But what exactly is a stock index? To answer that, let's first define what an index is. An index is like a ruler. It is a way of measuring the performance or price movement of just about anything. One index you may have heard of is the Consumer Price Index, or CPI, which measures inflation. The Consumer Price Index measures the change in the price of a basket of goods and services. Say you had a shopping list that contained 10 items. The total cost of those 10 items equals $100. We will give the index a value of 100. Next year, you buy those exact same 10 items, but the total cost is $110. The index will now have a value of 110. We can calculate the percentage change over that year with the following equation. Percentage change equals current index value minus previous index value divided by the previous index value times 100. In our example, we would get 110 minus 100 divided by 100 times 100 equals 10%, where the current index value equals 110 and the previous index value equals 100. Now that we have defined what an index is, we can find out what a stock index is. A stock index is like the Consumer Price Index, but instead of measuring the prices of a basket of goods and services, it measures the prices of a group of stocks. Stock indexes are used to measure the performance of a stock market. When someone says, "The stock market was up yesterday," they are usually referring to the S&P 500. The S&P 500 is made up of the 500 largest stocks in the United States. If someone says, "The Australian stock market is down," they will usually be referring to the ASX 200 or the All Ordinaries. The ASX 200 is made up of the 200 largest stocks on the Australian Stock Exchange. Some other stock indexes include the Nikkei 225 for Japan, the FTSE 100 for the UK, the Hang Seng for Hong Kong, and the DAX for Germany. There are three main types of stock indexes: price-weighted, value-weighted, and unweighted. In a price-weighted index, the greater the price of a stock, the more weighting it will receive. Say you have an index made up of two stocks. One is priced at $100, the other is priced at $20. The change in price for the stock priced at $100 will have more of an impact on the index than the stock priced at $20. In a value-weighted index, the greater the market cap of a stock, the more weighting it will receive. A stock worth 10 billion has a greater effect on the index than a stock worth 1 billion. In an unweighted index, all the stocks are given the same weighting. All stocks in the index will affect the index equally. There are two main ways to invest in a stock index. They are index mutual funds and index ETFs. An index mutual fund is a pool of money that a professional will use to invest in an index. An example of an index mutual fund is the Vanguard Index Australian Shares Fund, which tracks the ASX 300 index. Index mutual funds will usually have an investment minimum. For example, the Vanguard Index Australian Shares Fund requires a minimum initial investment of $3,000. Index mutual funds can only be bought and sold at the end of the day. ETFs, or exchange-traded funds, are funds that can be bought and sold on a stock exchange like stocks. Investing in an index fund is a great way to get started investing if you don't know how to pick individual stocks. Both index mutual funds and index ETFs are low-cost ways to invest in stock indexes. Over the long term, 10 years plus, you likely won't see much difference in the performance between an index mutual fund and an index ETF tracking the same index. Investing in either an index mutual fund or an index ETF is considered passive investing. Nobel Prize laureate Harry Markowitz said, "Diversification is the only free lunch when it comes to investing." Investing in index funds is popular because it allows you to invest in hundreds of stocks at the same time. Just take a look at the above chart, which tracks the S&P 500. It has gone from around 85 in 1971 to 3,898 in 2021. That is an increase of 4,485%. $1,000 invested in 1971 would now be worth $44,840. Another reason people invest in index funds is that they can't or they don't want to spend time trying to pick winning stocks. Instead, they just buy them all, or a large number of them. By investing in index funds, you are saying that you believe that businesses, in general, are going to continue to grow and produce profits over the long term. Just listen to what Mr. Buffett has to say about index funds.
The very nature of index funds is that you are saying, I think America's business is going to do well over, or reasonably well over a long period of time, but I don't know enough to pick the winners and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often.
Mr. Buffett also once said, in my view, for most people, the best thing to do is owning the S&P 500 index fund. In summary, an index is a way of measuring the performance or price movement of just about anything. Stock indexes are used to measure the performance of a stock market. There are three main types of stock indexes: price-weighted, value-weighted, and unweighted. There are two main ways to invest in a stock index. They are via index mutual funds and index ETFs. Investing in an index fund allows you to invest in hundreds of stocks at the same time. You may choose to invest in an index fund if you don't know how or you don't want to try and pick winning stocks. Warren Buffett recommends most people simply invest in an index fund, such as the S&P 500. If you want to learn more about index funds, check out the following resources.